I'm Kay. This is Frankly Kay, where awareness and clarity means power. Here we do financial literacy videos, book reviews, journal with me's, and vlogs. So if any of that is interesting to you, please just consider subscribing and stick around because there'll probably be a vlog next week. Exciting. Today is a new segment in Frankly K, Frankly Financial, the financial literacy segment. And part of financial literacy is being aware about current events, right? So guess what I heard? That's the name of the segment. It's a big election year in the US. That means presidential. We have multiple election years. On off years from presidential things, you vote your like state elections and stuff like that, city elections, all those things is a constantly running game. So that means that both sides of the popular parties, I'm fiddling with my microphone, both sides of the popular parties are marketing promises and plans that will help sway constituents as in the voters. In the case of the current Biden administration, it's cracking down on bank bailouts. Or at least that's what it had started to do. This is something currently on people's minds, mainly because of the whole Silicon Valley bank scandal that happened. And apparently it was the biggest collapse of a bank since 2008 when we hit that recession. So wild. If you aren't familiar with the Silicon Valley Bank disaster. Sorry, no, it's just a bank fail, right? I said before, banks fail all the time, but this one was really big, and it was really big because there was lots of money involved. Cliff Notes version. Now, SVB, Silicon Valley Bank, its main focus was financing and providing banking services to tech and healthcare startups. Keep that in mind. SVB didn't do anything that most banks don't do, in a sense. So they were taking their deposits and they were investing them. The problem with that is they did not have a diverse portfolio of investments. You should have seen that online all over the place. They didn't have a diverse portfolio of investments. When it came time to pay up, they couldn't, and that's why they crashed. Cliff Notes. Skip ahead to the next chapter title if you don't want to hear the longer explanation of this story. If you do, here it goes. So the Frankly Finance gossip version of the SVB bank fail, so that we can get back to the point. SVB focused on investing into U.S. treasuries and agency mortgage-backed securities. But in 2022, the Feds hiked interest rates to stifle inflation, and as a result, long-term bonds decreased. Now, why does that happen? In my explanation, this is the most concise way I can explain what happens. And I'm going to read it to you, okay? So again, because I write things out in the clearest way possible, and if I just start trying to paraphrase, I might start backtrack. Anyway, because bonds are how the government, federal or municipal, receives private loans. That's the bottom line of what a bond is. If you didn't know what a bond is, you are purchasing a loan, like as in the government is asking you, you know what I mean? Like they're not asking you, they have it there available, and it's like a way that they receive a loan from businesses like banks or regular people like you or me. They receive their private loans that way. Because bonds are how the government, federal or municipal, receive private loans. There is a time frame in which they have to pay back your loan, and in between when you lend them this money, aka purchase a bond, and when the time frame, aka a term, is up, the receiver of the loan, aka the issuer of the bond, pays out the interest collecting on said loan. So much like with your own loans or credit cards, when the Fed hikes up interest rates, loan rates go up, meaning your bond yield will increase. The amount of money you're getting back on the bond increases. So bond prices will go down when Feds hike up interest rates, because when interest rates go up, loan demand falls due to increase in the cost of interest. How did all of this affect SVB? Right? So SVB had way too many long-term investments such as bonds and these mortgage-backed securities. All those things are tied up they're supposed to be tied up for a length of time. And they did this to increase the amount of money that they could be making off of these investments, because rates of return are a little better than maybe short term. Long term is always going to be a little better than short term because it's more money to accumulate, right? The problem with that is when you're an entire bank and you're doing tech and healthcare startup, what happens in tech and healthcare, especially with startups? They need cash, and they need lots of cash. The bank didn't have no cash to give, girl. So not enough money could be liquid in a hurry without taking a big hit, because long-term investments can not only penalize for early withdrawals, but they haven't reached maturity. So they aren't even at full worth when you're cashing them in. It's basically like saying, here's a loan of $1 million for 10 years. And then 2 years in, you're like, hey, gonna need that milli back. You're not gonna get all your money back. So you're gonna get whatever percent of that money is proportionate to the length of the loan you've cut short. No further interest, no further value. So that is what happens when you have long-term investments that you have to make liquid, instead of having short-term investments that are already liquid or easily liquidated without major losses, because it is a short-term investment. It may be major or no losses. It might even have gains because it's made to be a short-term investment. It's made to be back into cash. So when the pandemic hit a stride and venture capital wasn't pumping money into those tech and healthcare startups like it was, those startups needed cash. And of course, like I said earlier, those kinds of companies need lots of cash, and their accounts were in the millions. So guess what? They needed hundreds of thousands of dollars to pay people. They needed millions of dollars to pay people to keep business running. Every day, expenses need to get paid. They're pulling out this money because venture capital isn't coming from the other end. And guess what? SVB doesn't have it to give them. So they start liquidating their assets, aka their long-term investments. So what did they do? They took the loss. Because of this quick sale that they were doing, basically they had to announce they were doing a quick sale of their assets so that they'd be able to pay their investors and depositors back their money, because it's more like paying their depositors back their money. They had to make this quick sale so that they'd be able to give people cash that they needed. That made investors and depositors very nervous, because they're like, why are you quick selling in order to give me money? Where is the money? So in a frantic panic, a lot of people started to pull out their money, and that continued to make their stock prices and their value drop stockly. I think it said 60% or something like that. While Charles Schwab said it was about 60% of a loss on the stock market. So that's also not going to look good, causing more people to, guess what, sell. Ooh, I'm choking. Cause people to sell their stocks. Okay, so that's more losses for the company, all because of this short sale, this quick asset sale. Apparently they also, people in the banking industry or SVB themselves, I can't remember who, tried to blame Twitter and Twitter users for the bank's collapse because of how fast the panic spread online. But let's be real. The bank's analysts or the people in charge of its investing direction needs to eat that L. It's like I invest in a CD. And then my car breaks down. And I have no liquid savings because I kept pumping all my money into CDs that are all locked into 15-month rates. But I need this money. I've got to get to work. I don't have any money I don't have $2,000 for some reason. I've got maybe $10,000 worth of CDs, but they're all locked in at 15 months because that's where my savings plan was going. However, I did not leave any liquid cash for emergencies and for use. So I have to go get penalized for withdrawing from my CDs. I don't even get the full amount of profit that I was putting the money in there to get in the first place, because I didn't leave it in for the 15 months. It's been maybe 6 months or something like that. And now I'm going to get penalized for withdrawing out of that CD for this cause. All because I didn't have any liquid money. Just like that. Depositors need cash. You're the bank that's holding their cash and you don't have it. wasn't Twitter. This is why new regulations were being announced earlier this year or at the end of last year. I don't know the time frame, but they had already been announced that the country's largest banks, names you're all most likely aware of, things like Wells Fargo, Bank of America, PNC, Goldman Sachs, those kind of JP Morgan, Chase. SVB was the 16th largest in this country. So this would have included them, I'm assuming. I'm definitely assuming. The new regulations proposed that these banks, these very large banks, would need to set aside bigger emergency funds, basically to sum it all up. And why? It was so that if a collapse happened again, another large bailout would not have to take place. Because did I mention that SVB's accounts were in the millions, each one of them? And yes, they were FDIC insured, but what have I said before? FDIC insurance only covers up to $250,000 per account, but it's only $250,000. So if they had multiple accounts, each capped at $250,000, maybe it wouldn't have been a problem. However, they didn't. Most of these people, they had like one or two accounts or something like that. It's a business. You're not going to have multiple accounts every time you hit 250,000. That'd be way too many accounts. So they had millions and millions of dollars in this account. And guess what? All of them got their money back. Every single depositor at SVB got their money back. Private depositors, business depositors, everyone. Why? Because the FDIC was like, well, this is going to make us look bad. But now SVB owes people a whole bunch of money. So to stop that from happening again, new rules were demanding that largest banks should beef up those books. Because they're basically like, we're not coming out of pocket like that again. However, these lobbyists have a job to do, right? And they decided it was too much. They were like, you're doing too much. And they don't want to have this money just sitting there. Sorry, still playing with my microphone. They don't want the money sitting there not making them money. The bank. Like it's a person. Just like a regular person, they're always telling you, you don't want your money just sitting there not making money. Sometimes it has to, right? Because you need it to be available. That's another talk. I think it's really a short-term thing to be like, we don't want our money just sitting there and not making money. You're not thinking of the big picture. You're thinking really isolated. Not short-term. You're just thinking very isolated. You're only thinking about profit and growth. You're not thinking about sustainability, where there needs to be some balance between large investing, high yield investing, and the ability to access money without penalty. There needs to be some balance, especially when you're dealing with millions of dollars. Have money on hand that can go for whatever it needs to go for. And then you have your investments on the side. But whatever. The lobbyists are basically being like, we put enough money to be on hand and we don't want to be putting any more. These new rules, they're out of control. They made a big kerfuffle about it or whatever. And then yesterday, I'm saying yesterday now, today is March 7th, and J Powell gets up there and is basically like, so never mind about all those big numbers and whatnot we mentioned before. There's still some stuff we have to work out, so we think we're gonna minimize the numbers that they were asking for before. I don't know what those numbers are. I didn't bother looking at them. The whole point is that, once again, the banking industry has lobbied their way into sidestepping common sense. All for the sake of profits. Now, those profits can benefit the people that are involved, including people who bank at those places and whatnot. But overall and largely, I don't know if I'm really in agreement with that. While I understand it, I just think, once again, everything needs balance. Like, you don't need to have the largest amount of ridiculous funds there. You just need to make sure that you have enough to cover anything that might come up, your emergency funds. Like how they're always telling people, have 6 months of emergency, 3 to 6 months of emergency funds. Banks should have 3 to 6 years of emergency funds or something. I don't know. You would have to think about the bank, its structure, what its main base depositor outreach is, right? Those are all things you take into consideration, but I think it's completely doable where banks can maximize their profit goals and also maximize their safety, their sustainability and their safety when it comes to emergencies. So lobbyists, though, they also are still pitching the fact that these numbers, this whole new regulations for more money on the books than in an investment. I just keep saying on the books, but I just mean more money liquid than in investment. And when you say on the books, it doesn't really mean that the money is liquid, because anything can be on those books, including your investments. So they need more money available for emergencies. The lobbyists are saying that they have enough money for emergencies, and the number is outrageous because they're already being sideswiped by commercial real estate losses. Yes, that is why a lot of you are now returning to work full time instead of being hybrid and living your life to the best ability. Even though they said productivity was up, people keep saying team and cohesion and communication is going off. And I just feel like all of those are willing fails so that they can get people back into the office. Now, I am not someone who's ever worked remote. However, I feel like a lot of people have the full ability to work remote, but they like to reserve it for some people. And I think they're still trying to keep it like that. Like they want remote work to be some sort of private club. And it's mainly because they have all this commercial real estate that a lot of banks have invested in. A lot of private companies have invested in. And so they want to push people back into those properties. And they told on themselves when they was out here, like, commercial real estate is really hitting a loss with all this hybrid and remote work, because they tried to tell y'all productivity was down and y'all couldn't communicate. But what it really is that somebody's losing money because nobody's using those offices and they're going to become obsolete. Therefore, they're going to have to find someone to sell it to, and who's going to want to buy it because it's commercial real estate. And if the commercial people that are supposed to be in there aren't there, then nobody needs to buy it. That's what's really going on there. And that's how this lobbying affects you. Because if they were really to do what they had initially said before they backtracked, before Jay Powell announced the backtrack, I'm not blaming Jay Powell. He is the messenger of the horse. He's the horse's mouth. He's the messenger. I don't know, whatever. He's relaying what's happening and is basically like, if they're not held accountable to keep these emergency funds and a big downturn happens again, or something else that hits them hard happens again, like for instance, the aftermath of COVID and all the remote work, how they're forcing people back into these buildings and people are quitting in droves. And I feel like people who are able to do that, they are right to do that, because if you're only doing something one-sidedly, then how do you expect the other person to be okay with that? Like, if the company is only thinking about the company when they make this decision, then the employee is allowed to only think about themselves. You know, if everyone's going to think about themselves, then it goes both ways. That's how life works. Otherwise, it's just abuse. People who can't afford to do that, it's a bullshit situation to have to go through. But this is partially why. Because they want to recoup the money that they have spent on commercial real estate investments. And that is partially why you are going, not partially, that's the main part of why you are being forced back into the office 4 to 5 days a week, in my opinion. But what do I know? Anyway, thanks for watching this little segment. I hope you enjoyed it. I really enjoyed it. And then hope you learned something as well. Yeah. So see you next time.